is LLC-S Corp-C Corp. What is the right entity structure for you? The short answer is it depends. The long answer is I'm going to tell you what it depends on here in just a moment. So we're going to be breaking this down: when to use an LLC, when to use an S Corp or an LLC tax as an S Corp, and when should you use a C Corp. There's case situations where you're going to use both. And I want to break that down for you, whether you're a real estate investor, small business owner, big business owner, you got a side hustle. I don't care what you're doing. I'm going to break down when you should be using these types of entities. Now, I'm Matt Sorensen. I'm a wealth lawyer, partner at KKOS Lawyers, CEO, award-winning Inc. 5000 entrepreneur at Directed IRA. And I've helped 10,000 plus clients set up entities. Every month, my law firm sets up over 500 entities for clients across the country. We've gotten into the weeds in what type of entity you should use in which situation. And so I'm going to break that down for you today, go over these different entity choices that you have as you're out there starting up your small business. Some of you might have one of these entities you need to change, and I'm going to get to that and how you fix it if you've already set up the wrong type of entity for your business and you want to transition over. So we'll come back to that as well. Now, we'll be taking live questions. Live questions get priority today. So if you have any question, no matter what medium you're on here, whether it's YouTube or Facebook or Instagram or LinkedIn, no matter where you are, please type in your questions. My team here will be sorting them out. We're going to prioritize questions relating to entity setup and these different entities we're going to be talking about today. And then towards the back end of the live, we'll be hitting other questions across a number of different areas, whether it's retirement, wealth building, any other questions you might have. Happy to hit those. We already have a number that came in advance. I'll be hitting those as we go out through the day today. Now, I've got some diagrams. I'm going to be whiteboarding. We're going to nerd out on this because it does get a little bit technical. The good news is it's not that complicated once you get it. And all you got to worry about is your specific situation. You don't need to know this for everybody and every type of situation that you could encounter. That's the tax lawyer, the business lawyer's job. What you need to know is what matters for your situation. Like, what are you doing? And my goal here is by the time we're done with this, you're going to have a clear understanding of what type of entity to set up in your situation or what you might need to do. Some of you might need an LLC and an S Corp, for example, and we'll go over that as well today too. All right, well, let me break this down, and I want to just show a quick diagram here that goes over the types of entities that we typically use. Now, you see here on the screen, we have what we've called the trifecta. In our law firm, we do this trifecta structure, which consists of your trust, your estate plan, which is just for estate planning purposes. Trust should not be used for asset protection planning. They rarely are. In our mind, land trust and these Delaware statutory trusts, overused. We don't use them for most clients. And you know what? Most legit law firms don't either. So I want to be looking at S corporations for your business or operations, LLCs for your assets. And you can see there, we have a dividing line, business on one side, assets on the other. And assets are going to include rental properties, crypto. This could be your stock portfolio. And we're not going to put your home in it. Your home there on the bottom is going to be owned by your trust. But any of your rental real estate, land, second home, those things owned in an LLC. And then your operating business, we're going to want to own in an S corporation. Now I'm going to get to why. I'm going to explain the why. I just want to give you a big picture so you understand that S Corps are used in certain scenarios, LLCs are used in certain scenarios, and I'm going to get to the C Corp as well. Less common for small business owners. Don't use a C Corp for you real estate investors, but there is a use case. I have a C Corp in my life. There are use cases where you may want to use a C corporation depending on your business or your activities. Okay, so now that little diagram I just showed a moment ago is called the trifecta. There are two things we're trying to do when we're thinking about the entity selection for your business or investments. The first thing, which is pretty universal and straightforward, is asset protection. The second thing is going to be tax. Now, tax is where it depends, and where I said at the beginning, the right entity selection for you and your business or investments depends. And so I'm going to get to the tax scenario. That's where we're going to have a lot of nuance and variation, but I want to break it down so you know in your situation what to do. But let me go over asset protection. Asset protection, the general type of asset protection people set up any entity, whether this is a corporation or an LLC. The primary reason we're getting asset protection is if something happens in that business. Let's say I'm an S corporation and I'm a contractor. Something goes bad on one of my customers or on something I've built. Well, they can't sue me. I didn't perform those services. They have to sue my S corporation. They sue my corporation. And that's the same whether it's a C corporation. Now, let's say on the other hand, I have an LLC for my rental properties, tenant slips and falls. Well, they're forced to sue the LLC. They can't sue me personally and get at my personal assets. I don't own the rental property. My LLC does. And so you get this corporate veil protection in LLCs and corporations that protects all of your personal assets from your business liabilities. So that universal principle for asset protection applies to corporations and LLCs. I'm not personally on the hook for what happens in my corporation or my LLC. Now, if you commit fraud or things like that, you're going to have problems. They can get through the entity down to you personally. But if it's simple negligence or a bad deal or investment or a slip and fall or an accident, those are liabilities that you could be responsible for. But if you use the S Corp, corporation, or LLC, they get stuck at the entity level. They can't come down and sue you personally. So that asset protection is going to be universal. That is a reason in and of itself to use an entity. Now, where we get to the nuance is going to be the tax scenario and the taxes that are paid and how to minimize that in your situation. The goal here, right, is to have maximum asset protection and minimal tax liability. Like, that's the goal. We want to maximize your asset protection and minimize your tax liability. So how do I minimize my tax liability by using an entity? Well, let's go to a chart here. I've tried to make this handy dandy little chart here for everybody just to kind of break it down, because this gets complicated. And but it's, once you get it and you learn it, like I said, just know it for you. I'm going to go through the common examples so you know where you're going to fit here. All right, LLC. Everyone hears about LLCs, right? LLC this, LLC that. Let me tell you, LLCs do not save taxes. Let me repeat that. Setting up an LLC will not save you taxes. LLCs are what are called pass-through entities. You can see there on the first line, it's a pass-through entity. There is no company level tax at the entity level. LLCs don't pay taxes. You're not going to pay a tax because you have an LLC. Instead, they pass through the taxable income down to the owner of the business as if the entity didn't even exist. So on the one hand, you can say, well, that's great. LLCs don't have a company level tax. I'm going to get to C Corps here in a second. By the way, you pay a tax at a C Corp level. One of the things we don't like about them. But in LLC, there's no company level tax. It just flows down to you as if you personally own that business, and what they call pass through from a tax standpoint. So you don't save taxes, you don't pay more taxes. The LLC is tax neutral. Now, let's say you have a small business, okay? Let's say that you have an e-commerce store. We have a question in here about an e-commerce store and an LLC. Let's say that you own an e-commerce business, and let's say that you make $100K a year. That $100K, this is after everything you can expense, that $100K is just going to go right through the LLC onto your Schedule C. This is Schedule C is your personal return, and you're just going to pay taxes at your regular tax rate, as if you didn't even have an LLC. So the LLC doesn't cost you tax. It doesn't save you tax. It's tax neutral from a federal tax standpoint. So let's say I had an effective rate of 20%, 25% on 100K. I'm going to pay 25 grand in, let's say, state and federal tax. I'm just estimating here on 100K. You're also going to pay self-employment tax on that 100K of 15.3%. That's Medicare and Social Security of $15,300. I'm going to come back to that here, but just think company level LLCs do not have a corporate level tax. All right, do you have a question right now, Tristan?
Yeah, we actually got a couple questions come through, so I'll read one off here for you. Terrence on LinkedIn wants to know, can you discuss how single member LLCs should just pull from their business bank account versus setting up payroll and paying themselves through a salary?
Okay, let me get to that. In fact, let me hit this. Let me go over the tax scenario on LLC-S Corp, and then I'm going to come back to that question. So flag that one, because we're going to pop that one back in, because that's a great question for 2 points ahead. You're already ahead of me, Terrence. So I appreciate it. Good question. But let me come back to that, because this will make more sense for everyone else that may not understand the context of that question. Okay, so S corporations. S corporations, there's no corporate level tax there either. S corporations are a pass-through entity as well. So that income that the S corporation makes passes through down to the owner at their individual tax rate as well. A C Corp is what's different here. And if you look at the diagram here that I have, in a C corporation, you pay corporate tax of 21%. Okay, 21% is the corporate level tax that the C corporation pays on the C corporation tax return before you can distribute any of that money down to you as the owner of the business. Now, this is the big knock against the C corporation and why a lot of small businesses, medium businesses don't use a C corporation. Big businesses use C corporations, publicly traded companies. It's a requirement to be publicly traded, essentially. There's reasons why you may want to do it for institutional ownership. C corporations are really for large businesses or startup businesses. I'm going to come back to that, why you might want to use a C corp in a startup that you think might go big. But in a C corp, we got 21% corporate tax. And then when that profit is distributed down, there's also a dividend tax to the individual. If it's a qualified dividend, the max rate of that is 20%. So the total tax you're going to pay is 41% there. That's if you're making good money in a C corp. You're going to be paying 41% out of the C corp. Now, an S corp max rate's 37%, LLC max rate's 37%. That 4% difference there is why C corps are rarely used in small business. Definitely don't use it in real estate investing. The reason you don't use a C corp in real estate investing is, let's say you sold a property, you owned a property and you sold it after 2 years and you had a capital gain. Well, capital gain rate max is 20%, right? Well, you actually have to pay 21% corporate tax on the capital gain. Then you pay a qualified dividend as well, which is up to 20%. So you doubled your tax rate here by running real estate through it. So never do rental real estate in a C corporation. That is the worst place to put any rental property. Every 6 months, one of our tax lawyers encounters someone that did this, and it's chaos to get it out. It's painful to get it out, but you definitely need some help there if you've done that. Okay, so the primary difference between LLCs and S corps versus a C corp is the corporate level tax. Okay, so let's leave C corp off the table here for a minute, because 99% of you should never touch a C corp, never set one up. If you have one, our team definitely wants to look at why do you have it, and let's make sure you really did it right, because you're probably volunteering extra money to the IRS by having a C corporation. Let me make sure everyone understands that. If you are doing this wrong, if you are structuring this improperly, you are volunteering more money to the IRS. Like the IRS has given us some roadmap to say, all right, if you want to pay us less tax, do it this way. And so many people are jacking it up or being lazy about it and volunteering more money to the IRS and to their state because they're not freaking paying attention. This is out there. It's right in the tax code. The map is laid out for you. You just need to run it the right way to minimize the tax liability so you're only paying what you have to. We do not want to volunteer more tax revenue unless you want to. Okay, so I can't say I've ever ran across a client that's wanted to. Most would rather just give it to charity if they want to be charitable. Okay, so let's pop over to LLC and S Corp, because those are going to be the two main entities you're typically going to use. And let me do what we call the trifecta here. I'm actually going to draw it here for a second. If you think of your life and your entities in terms of let's draw a line down the middle. On one side over here, we have operations. Over here, we have assets. And down here, we have the trust. Now, my partner, Mark J. Kohler, and I, we have perfected this over the years and came up with this strategy on how to separate our clients' operations versus their assets. Now, if you are a small business owner, we typically want to see an S corporation over here on this side. I'm going to get into why here in just a second. And then we want an LLC over here. That LLC, for example, is what's going to own your assets, for example, a rental property. Okay, I'm just going to keep it basic here. We can add to this as we get through here as people have questions. Now, you own this 100%. If you don't have a trust for estate planning purposes, this is just you personally, okay? The trust doesn't do anything from a tax standpoint. It's just there for estate planning. So it's disregarded for purposes of taxes. It's just you. All right. The reason I'm going to use an S corporation here is in an S corporation, if we look up here, I don't pay any tax at the company level. But when the business makes money, I'm going to pay tax up to a maximum individual tax rate of 30%. But I also have to pay some self-employment tax. If I have any operational income, that would be selling goods or services, I have to pay self-employment tax on that money. Okay, I don't care if you get driving for Uber, you got an e-commerce store, you're doing consulting, you're a healthcare practitioner, you're a dentist, doctor, lawyer, whatever. You're providing goods or services. That income is subject to self-employment tax. On the other hand, income from investments, for example, a rental property, is not subject to self-employment tax. There's no self-employment tax on it to begin with. Okay, rental income, investment interest income, dividend income, capital gain income, which is what the income you get from your assets, it's already exempt from self-employment tax. You don't have to pay it on any. So no self-employment tax over here. So we want to put assets over on this right side where we have no self-employment tax. Think of your rental properties, investment accounts. This could be second homes, like I said, land, all that stuff. That's over on this right side over here for assets. I don't need tax planning to save on self-employment tax for my assets because it's not due on it at all. I do need some tax planning to minimize self-employment tax if I'm selling goods or services, though. And this is why people use an S corporation. I'm going to explain how this works. I got a calculation for it. The sole reason people use an S corporation is for one tax. It is to minimize one tax, and that is self-employment tax. Self-employment tax is a max rate of 15.3%. This is your Social Security and Medicare. When you're self-employed, you pay the employee part and the employer part. That's why it's called self-employment. It's double, which is that 15.3% tax return. All right, now let me get into the why on the S Corp here, and I got a slide for this, so hang with me. Okay. Let's say you had a business that made 120 grand. And let's say that you had 20,000 in expenses. And let's actually unshare this slide here because it'll confuse people. Okay. 120,000 gross income, 20,000 in expenses. So you had 100K that you picked that was profit to you as the owner of the business. Now let's say you were a sole proprietor or you just had an LLC. Well, when that 100,000 of taxable income comes onto your personal return, it'll go on Schedule C here because it's selling goods and services on Schedule C. You're going to pay income tax at whatever income tax bracket you fall into, but you're going to pay self-employment tax of 15.3% on the entire 100K. So that's going to be $15,300 of self-employment tax on 100,000 of income. That kind of sucks. Then you pay income tax at your tax bracket and state tax if you're in a state that has state income tax. Now the solution, and let's share the slide now, is the S corporation. Let's take that same 120,000 of income, 20,000 of expenses. So you have 100K net that you get to pay yourself. Now, the reason there is an S corporation is there's a strategy there that says, hey, if you take profit, also sometimes called dividend, out of an S corp to yourself because you own the business, that profit or dividend from an S corp is exempt from self-employment tax. You don't even have to pay self-employment tax on profit or dividend from an S corp. Now, a lot of people are like, awesome, Matt, I'm just going to pay myself 100K of profit or dividend. And I would tell you to do that because that would wipe out all of the self-employment tax, right? We'd save $15,300 in that example. But the IRS doesn't let you do that. They say if you work in the business too, you have to take a reasonable salary as the owner of the business. You can't push it all out in profit or dividend. You must take a quote unquote reasonable salary. Now, in this example here, reasonable salary would be around 40K. It varies here. Maybe it's a third of the total income. There's a whole matrix on this. The greater your income, the lower salary ratio. But here on 100K, we might do a 40K split. That'd be totally reasonable. Now, that 40,000 of salary I take, I pay income tax on it, and I do pay self-employment tax on that 40K, which 15% of 40K is $6,000. But that other 60,000 that I got to pay down to myself as profit on a K1, that's the form there, That is exempt from self-employment tax, and voila, I have saved $9,000 in taxes. Now, this strategy is out there for everyone. This is for everyone. Like I said, I don't care what goods or services you have. If you have an operational business, if you're making 10 grand, actually, let's say you're making 100 grand, a million, 10 million, I don't care. Joe Biden had an S Corp running millions of dollars of income through it, saving him tens of thousands, $100,000 in taxes by using the S Corp. This is not a crazy strategy or an aggressive strategy. This is tried and true. There is a reason the vast majority of small business owners have an S Corp is because of the self-employment tax saving strategy, where you can take advantage of being the owner of the business. Because as an owner of the business, you want to take profit out. That's not wage income that you should have to pay Medicare and Social Security taxes on. So we get to rip out some of that profit and dividend without having to pay Medicare and Social Security tax on it. Why should I have to pay self-employment tax on it? I'm an owner of the business. This is business income coming through. Self-employment tax is meant for wage income. So we take a reasonable allocation of that on the W-2. And like I showed in this example here, we did a 40-60 split, but that could be 1/3 to salary, 2/3 to dividend. And as your income goes up, the net income here goes up. You could even be getting to an 80-20. I don't know. You want to talk to your accountant or CPA. We have a whole matrix on this. In fact, we should link that. My partner, Mark, did it. He calls it the Kohler payroll matrix that shows kind of what salary allocation to take. And this is something you could talk any Main Street Tax Pro, which is part of the Main Street Tax Pro network that Mark has also knows this strategy, and they can help you implement this on your taxes and in your payroll. I'll just give another example. ADP. Okay. We refer clients to ADP for payroll setups. They understand this. Okay. Biggest, largest payroll company, ADP. They do this with their clients all the time because it's, again, a tried and true strategy. So don't think this is like super aggressive or out there by doing this S corporation tax strategy. It is the bread and butter for small business tax planning. Okay. Now, some people might be like, oh, Matt, 9,000, that doesn't sound like a lot. Dude, I just saved you $9,000 in taxes in year one. You're going to use this strategy every year over and over and over and over again. Now, let's talk about what it takes to execute that. You got to do a corporate tax return. You got to do at least a quarterly payroll. You don't need to run a paycheck every week or 2 weeks to pay yourself. Okay. You can do that if you want. Most small business owners just do an after the fact quarterly payroll where they say, all right, I took out 30K of the business this year, or my net after all the income and expense, I really made 30K this quarter. I'm going to consider 10,000 of that salary, 20,000 of it dividend. I'm going to run a payroll report for $10,000 of salary. So you want to communicate with your payroll provider, or accountant that would help you with this about how much to be reporting each quarter as salary. And a lot of clients just say, just do this as the default, and I'll let you know if I need to ramp it up or down depending on how I'm doing through the year. So don't overcomplicate this and think you need to be cutting yourself a paycheck and doing a payroll every 2 weeks. This is an after the fact payroll you can do on a quarterly basis. Now, if you have employees and stuff, of course, just run your payroll with the rest of your employees' payroll if you want. But a lot of like solopreneurs, for example, they're just doing the quarterly payroll. No reason to run a biweekly payroll. All right, now let's come back to that question that Terrence asked, if you don't mind, because that was a good question. I've already forgotten it, but I knew I needed to get through this self-employment tax.
Yeah, I'll throw it back out there. Can you discuss how single member LLCs should just pull from their business bank account versus setting up payroll and paying themselves through a salary?
Okay, great question. Okay, if you're using an LLC, presumably you're having an LLC taxed as an S corporation. Okay. So let me go over the two different options you have there. If you just are doing an LLC, and let's go back, actually, let me get back to my little chart here. Okay. Let's say that, Terrence, let's say that you have just an LLC. It's not an LLC taxed as an S corp. You just have a regular LLC that just flows down to your personal tax return. You don't do a payroll. You're considered a sole proprietor for tax purposes. We want a bank account for the LLC. You're still going to have a business bank account for the LLC. We want to do that because it's easy to track your income and expense by just using that sole bank account. You also want it for asset protection purposes. You need to keep the business separate from your personal stuff. So you're going to have a business bank account for the LLC. When you want to pay yourself, just transfer money from the business bank account to your personal account. You don't need to run a payroll. There is no payroll if you just have an LLC. There's no W-2 that's issued. Okay. If you're just an LLC without an S Corp election, I'm going to get to if you did an S Corp, but if you're just an LLC, there is no W-2. There is no such thing as payroll. You just have self-employment tax. Now, you should be paying in, at least on a quarterly basis, to the IRS your estimated taxes, including self-employment tax, but there's no payroll process to be doing here on an LLC. So LLCs without an S Corp election, don't stress about it. Now, Terrence, you might have an LLC taxed as an S corporation. We have a lot of clients who have LLCs. It's a business that sells goods or services, and they're like, oh crap, I heard about this S Corp tax strategy. I wish I was an S Corp. Well, pretty easy fix. We can just add what's called an S election to the IRS that says, hey, IRS, treat this LLC like it's an S Corp, and they will let you have S Corp tax treatment for your LLC. We also do LLCs for a lot of new businesses starting out where they're not sure how much money they're going to make or if they even have profit their first year or two. So like, let me just be an LLC to get my legit business entity going, get my brand going, get all my vendors and relationships, get some asset protection, and I can add the S selection for the tax planning later on once I have the income. So let's say you have an LLC tax as an S Corp, Terrence. What you will be doing is transferring money from your business checking account, that's the LLC tax as an S Corp, to your personal checking account. You're the owner of the business, so you can do that transfer. But you do this after the fact quarterly payroll I mentioned earlier, where every quarter your payroll company, I mean, you could be doing this on your own if you knew what you're doing, but I just use a payroll company. Use your time to go figure out how to make more money in the business. Do not be doing your payroll and tax stuff like this. Go hire a professional that does this every day for people. But then you just do your payroll on a quarterly basis. And like I said earlier, if you had, let's say, 30K of net income or profit that quarter, you might say, oh, I'm going to consider 10,000 of that to be payroll. That'll go on the payroll report to the IRS. You'll pay 15% on that 10 grand, which would be $1,500. The rest of it, the other 20K is considered your dividend or profit, doesn't go on the salary. Now you may want to pay in quarterly estimated income tax payments to the IRS because you're not having anything come out of your paycheck every 2 weeks or every, twice a month. So you would want to send in some money to the IRS just so you kind of are not having to pay a big tax bill at the end of the day on April 15th of the following year. So that's all you got to worry about. Most small business owners think about that are particularly solopreneurs are thinking about quarterlies. And the reason why is payroll and then doing an estimated income tax payment. So I hope that answers your question, Terrence. Do we have a follow-up on that, Tristan? Okay.
Different question. Yeah.
All right. Okay.
This
What
one's
do we
back.
got?
We're on a trifecta question here.
All right.
I didn't see partnerships on the diagram. What if you're partnering with others to start a business?
Oh, great question. Okay. Let's say you have a partnership. I have this scenario. Okay. Let's say you're an architect. Okay. Let's say this is, let's say, what's the person asking this question's name?
Miss Corralejo, I think.
Okay. All right. Okay. Let's say you have a partnership. Now, I want to know, what is the partnership? Is this a rental property partnership, or is this an operating business? Let's assume it's an operating business. We love LLCs for partnerships, but we want to add in S corporations. Okay. So for example, Mark and I have a lot of partnerships. The LLC gets all the income. Okay. It's the business itself. It's the brand. It's what's out there. The business bank accounts in it. It pays all the expenses, whether that's employees or vendors or subcontractors. Okay. And then it sends the net income down to its owners. Let's say you have two partners. Now, Mark and I have the structure, my partner, Mark, and my law firm, and a couple other businesses we have, but we have this structure in common. We have this in a number of different entities where the LLC is the partnership. It's doing a 1065 partnership tax return. There's no tax due on it. It's just saying, here's the income, here's the expense, here's who got this much money, here's who got that much money. Okay. So there's a 1065 return, but it's distributing the profit down to one of our S Corps. This is Mark over here. And then we've got Matt's S Corp. Oh, what happened? Got a little excited there. We've got Matt's S Corp over here. Okay. And size does matter sometimes. So over here, this is my S Corp. So now let's say you're 50-50. Okay. And the business had, 300,000 of revenue, 100K in expense. So you had $200K to pay the owners. Well, you're going to have $100K going to each S Corp. Then each individual that owns their S Corp 100% does their own little S Corp salary dividend split. And you could be doing that same 60-40 thing I showed on the last thing, where you take a $40,000 W-2 and you take a $60,000 profit or K1. Okay, that would be what to do in a partnership scenario. Now, let's say this was a rental property partnership. We would just do an LLC that owns the property, and you'd have the two owners. Or this could be three, whatever. Let's say there's three partners, each 1/3, that went in on a property. See, I didn't add S corporations in here. Why didn't I add S corporations in here? If this is a rental property and there's just rental income or capital gain income when I sell it, there's no self-employment tax. There's no self-employment tax to start with on anything. I don't need an S corporation. I don't want to take a W-2. Why would I do that? I'm going to volunteer to pay more in taxes. So you don't use the LLC for rental real estate because it's all that income is already exempt from self-employment tax. Let's say you're doing private money lending, interest income and points, exempt from self-employment tax. You're doing stock trading or trading a stock portfolio, capital gain income, whether it's short-term or long-term, no self-employment tax unless you elect trader status, which you don't have to. And so why use an S Corp? So these are investments and assets. And we're just going to have individuals owning this LLC. And let's say this is 1/3. Now, if they had a trust, we would actually have their trust be the owner, each individual. But if you didn't have your trust, then it's just you personally owning that LLC. And then each of you get what's called a K1, which is, let's say this rental property. Now, most rentals will, even if it's cash flowing, generate a loss. So let's say that there was a $30,000 loss on this because you had depreciation, everything like that. Each one of you would get a 10K, a K1 with a 10K loss, okay, because you each own 1/3. So, but no tax up here at the LLC level, but there is a partnership return. There's still that 1065, but there's no tax due on it. It then just says, here's what the partnership made. Here's how much went to that partner, and that partner. And that's where it reflected on what's called the K1. The K1 is just a tax form for a partnership or even in a single member if it's 100% S Corp. All right. What do we got? Anything else live right now pending that I didn't hit yet?
Yeah, we definitely got a few.
Okay.
So we got another one from Instagram. This one's going to be from, you know what? I'm just going to read the question. In an S Corp, can your losses carry over? Or do they have to be used on the year the loss is in?
Oh, great question. In an S corporation, you can carry forward the losses. This is common, particularly for new businesses. New businesses starting out very rarely make a profit the first year. If you do, congrats to you. Most businesses have a lot of startup costs, and it takes time to start generating customers and revenue that you can rely on in the business. So if you have that in your first few years, or even you have a down year, absolutely fine. You take your return down to a 0 for that year. So there's no taxable income in the S Corp. And then if there's a loss past that, of course, that's going to carry forward and it applies to the next year. So those are called carry forward losses. And absolutely, you could use that in the S corporation. And like I said, that's very common, particularly in your first few years. Now, one important thing, and this is one thing that a lot of new business owners screw up, is you have to have income in the business. If you just have $100,000 of expenses and you sold not one product, not one service, there's no income, that loss carries forward forever. Okay. You can't use that loss against any of your other income either, unless you have some taxable services, or I should say taxable services. You have a sale, do you have any services or anything like that? Once you have that, then we can take that loss and maybe use it against some other income on your tax return. You may have another business, or you may have a W-2 or something like that, or a spouse. And a lot of times we can use that loss in the business, even in year one, to offset other income. If you don't have any other income that needs offsetting, that loss can carry forward into future years as well. So, but in order to really recognize that loss, to be able to use it in that year, you have to have income in the business. Otherwise, it continues to carry forward just on that company tax return until you actually have a sale.
Good segue for this question. Callaway Vacations on Instagram is asking, I have an S Corp. What if my income is negative for the quarter or even for the whole year? Do I still pay myself a salary?
Okay, great question. No need to. If you have negative taxable income, no reason to take a salary. I will say there's a little question of what's going on there. I mean, maybe it's just a down year, but we want to make sure all your expenses are legitimate there, of course. So, but that's totally fine. If you have a down year, or like I said, even a startup year, you don't have to start taking payroll in an S corporation. But if you have already been taking payroll, you still need to file. Once you start taking payroll, the IRS expects it to come at least every quarter. And if you don't send them anything, it's like, well, I had a loss this quarter, they're going to send you some nasty letters and be like, what the hell happened? So you need to at least tell them that there's no payroll to report, and you could just file a 0 payroll for the quarter. So, and that's totally fine if the business is floundering, even if you're working in it. Taking a 0 salary is okay. Now, let me get to when it makes sense to do the S corporation, because let's say you are just starting out, or let's say you just have a side hustle where you're like, Matt, I got a day job and that I'm going to keep, but I just have this side hustle I make 10 to 20 grand a year on. That's all I want it to be. It's just kind of my fun thing I do on the side, but I make some money at it. I'm not trying to grow it. And I've seen that a lot. I have clients that teach music lessons, or they do some consulting on the side. I don't care what it is on the side. If it's like, this is temporary, or it's just, I'm only going to try to make 10 or 20K a year over here on the side. Great. Let's not do an S corporation. Even though it's goods or services that you might be selling, even though you might be getting 1099s, the S corporation is not going to save you until you have 40 to 50K net income. Okay. Because if you think about it here, once you do an S corporation, we're doing quarterly payroll, and we got to do an 1120S, which is the corporate tax return for an S corporation. Those two things might cost you $1,500, maybe up to $2,000, depending on your accountant, to get done every year. So if I'm only making 10 or 20 grand net, and maybe I do a 50-50 or 60-40 allocation of dividend to salary, well, the tax savings I'm getting there on the salary dividend split isn't going to pay for the additional tax work that has to get done to report this properly. So you might just want to use an LLC, which is a disregarded entity, sole proprietor. It'll flow onto Schedule C of your tax return for a side hustle or for a business that you're not trying to grow necessarily. Now, the nice thing about using the LLC is if your situation changes, maybe you have a job situation, maybe this business takes off more than you thought, and you're like, man, I'm making 50K a year now, 100K a year net. We can just add the S election to the LLC at that time. You grow into it. And so it's a nice structure for some people that aren't sure how that business is going to do, to ramp it up and add the S election to their tax planning when they need it.
Awesome. Thank you, Matt. We have a few more questions to keep pouring in here.
Yeah.
Let's do this one to keep you on your toes. What entity should I set up as a Canadian investor in the US?
Ooh, good question. Canadian investor. All right. The one thing I'm not a Canadian lawyer, but we've run into them enough. There's a lot of them here in Arizona. Canadians, Canada is still going to tax your income. So the U.S. does the same thing. If you're a U.S. citizen investing in Canada or doing business in Canada, the U.S. is still going to tax your income. We have a tax treaty with Canada. The same thing, Canadian, what Canada does is says, cool, go make money in the U.S., but you still got to pay us taxes in Canada. Now, what both countries do is they say, from an income tax standpoint, we will give you a credit. Whatever taxes, let's say U.S. citizen, think of you, that whatever taxes you had to pay in Canada, we're going to let you reduce your U.S. taxable income by that amount. And Canada does the same thing because we have a tax treaty. However, when it comes to entities, it's not so clean. It's kind of a mess, actually. In Canada, they charge a corporate level tax on LLCs. So if you have an LLC in the U.S., you are paying a corporate level tax in Canada, even though the U.S. doesn't charge a corporate level tax on Canada, because Canada has this weird rule that treats LLCs like corporations, and in Canada, they have a corporate level tax for it. So we generally do not use LLCs in the U.S. for Canadians. You might use what's called an LLP or an LP. We use those quite often for Canadians that might be doing rental real estate down here. Those types of entities are exempt from And so this is going to be for Canadians. Ah, damn it. Sorry, did we get that on the mic? Okay, so for Canadians, you're going to use an LLP or LP, which is an entity that can give you asset protection. It's a little more complicated than the LLC, but not too crazy complicated. We've set these up for a lot of Canadians. This is going to be typically for real estate investing or partnership scenarios you might have down here in the US. Now, you can still use the S Corporation if you wanted. That's a little more clear cut, but you must also be a U.S. citizen or have a green card or permanent status in the U.S. to use an S Corporation. LLCs and LLPs like this, you can just be a Canadian with no permanent status or dual citizenship in the U.S. Don't worry about it. But S Corporations, in order to own an S Corporation, you must be a U.S. citizen, have a green card or some type of permanent status. Or otherwise qualifying legal status in the U.S. So S Corps aren't for everyone. But like I said, for the real estate investors, look to the LLP or LP. That's a pretty cut and dry for Canadians.
All right. Hey, awesome. Brandon Bridges on YouTube wants to know, if I want to separate ownership of the real estate that a business operates out of from the business itself, then how is depreciation handled when offsetting income to the operating company?
Ooh, great question. Okay, let's go back to the trifecta here on the whiteboard. Okay, let's say you have your operating business that is an S Corp, and you have an LLC, and let's say this is the building. This is a house, this is the commercial building here, and this is the business. Oh, I don't know. I keep jumping around. Okay. So let's say this is you 100%. Same owner. I've done this with a lot of clients over the years. Last one I just talked to was a physical therapist. Okay. He owns the building he's in 100% through an LLC. He has an S Corporation for his physical therapy practice. He's the 100% owner in both. Now, we want to own those in two different entities, right? Your business and the physical therapy is an S Corporation. That's selling services. And he's doing the salary dividend split there. Works great. But he leases the business. His S Corp leases from his LLC, which is great. He's got to do that at fair market value. You can't get any cute there. But he pays fair market value, which is an expense to his business, right? He's paying rent. So he expenses it over here. And then he picks it up as income over here. Awesome. Okay. He's got rental income over here in his LLC. Then he has an SBA loan. He's paying the mortgage. He's paying all the property expenses, right? Cleaning, insurance, all that stuff. Okay. Now he also takes depreciation on this. And the reason we had a call is you may want to do a cost segregation study. The reason to do a cost segregation study is this is a strategy where I can accelerate my depreciation expense. So let's say that, for example, you bought a property, you had a commercial property for $1 million. Okay. You got an SBA loan, you put down 10%, 100 grand. The bank financed the other 900K. I'm just giving, this is a rough example of what this client had. So you get to take that depreciation over time. Now, for residential real estate, this is 27 and a half years. So for those of you that are doing residential rentals, you take 27 and a half. I'm just going to run some math here. Okay, we're going to divide that by 27.5, which would be, if this was a residential property, which this is commercial, but this is residential rental, you would take $36,000 a year of depreciation expense, because you'd take just divide 27 and a half by $1 million. That's 36,000. So over 26 years, and this is straight line depreciation, you will have depreciated the whole $1 million value of the property down to zero. Now, in a commercial property, you do this over 39 years. Okay. And this is you have to take the land out of the property here. So let's assume that this was $1 million of property, actual building and such. But just assume land's out of the mix here. So just a little nuance there that I forgot to mention. But let's just hang with me. Let's say it's $1 million property. There's maybe 200K of land in that purchase. Okay, $1 million divided by 39. That's the time you take commercial property. 25,000. So you're going to have a $25,000 depreciation expense. Let's say this is 1 mil of property. Let's say land was 200K. So this is over 39 years because this is commercial. It's 25K. All right. Now he's paying rent. He's taking 25K. Now I can accelerate that depreciation by doing cost segregation. I might be able to double that depreciation time where I'm taking a 50K a year in depreciation. Okay. So now why would I do that? Now, the reason this question was asked, I believe, there's a couple of reasons you might want to do this. Now, we want to look at your tax situation and make sure we understand everything that's happening here. Let's say you have some other rental real estate. Well, that cash flows, that has positive cash flow. Well, I can use this loss here to offset some of that other rental real estate I might have. And I can kind of apply the loss over there to minimize my income. Let's say that I don't, though. Let's say that I just, after all my income and everything, let's say that he has a $20,000 loss, okay, on the rental property. All of his income, all of his expenses, he still has a 20K loss. Well, using what's called the self-rental rule, because he's renting to himself, he can aggregate this property on his return to take that 100K loss over here. Sorry, 20K in that example. He can take that 20K loss over here against his S Corp's income, against his business income. Now, generally, the only way you take losses from rental real estate, whether it's commercial or residential, the only way you can take losses from rental real estate against your business income or your W-2 income is if you are a real estate professional. But the self-rental rule allows any business owner, physical therapist in this example, to take this loss on the commercial rental and offset income over in the S corporation. That's called the self-rental rule. We do have some podcasts on that. Mark and I have done on the Main Street Business podcast, getting into the self-rental rule. We're actually using it this year in a property where we have an LLC we own 50-50, another business we own 50-50 that'll be renting it from it. So this is a very common strategy. It's one we've been teaching a lot more recently because I like business owners from a wealth building standpoint to be owning the business that they're operating their business in. If you're a physical therapist running that business for 20, 30 years as a professional, you're a dentist, doctor, a contractor, I don't care what it is. You have an office that you're operating your business from. Why don't you own the building? Over a long period of time, these SBA loans or even just commercial real estate loans, you might do a 15, 20, 25-year term. You'll own that building at the end of the day instead of paying someone else's rent to lease that property to you where they own the building after 20, 25 years. So we like this just from a wealth building standpoint. It also gives you certainty for your location. I've seen a lot of clients over the years who can't renew their lease and they put a lot of time and money into their office location. And then they go to renew the lease and the building's been sold or the owner wants to lease to someone else and you get booted out. So this creates some certainty too in the business as well, that location and that office is going to be tied in for your business and your benefit. So the last thing here is, of course, the self-rental is a way, if you do have losses on the property, can offset your other income. All right, we got another question, Tristan?
Yeah, we'll do a little bit of rapid fire this time around. Chat also wants to know if you were a doctor in your past life.
I was not, but no, there was a joke there from my childhood, but no, it was not a doctor. As much as my parents wanted me to be, no, they got the lawyer.
All right.
Wait. Oh, I know where that joke's coming from.
Yep.
My terrible handwriting.
Yes, it was a handwriting joke.
I got you. That's, and that's fair. My handwriting sucks. And what can I say? I've actually worked on it. Now this does look actually worse than usual. I do remember my third grade report card. Mrs. Train was my third grade teacher. Some great Mrs. Train stories, but she did, I did have a needs improvement for my penmanship, which was very discouraging because I was all about my report card in third grade. Once I got to high school, I could care less, but in third grade I cared. And I remember needs improvement on penmanship. So, I peaked in the 3rd grade.
A little trauma there.
Yeah.
All right. D. Saren from Instagram asked, will changing his LLC name reset his business credit history?
Ooh, well, changing your LLC name reset the business. No. Theoretically, practically, yes, because if you don't chase that name change down and communicate it to all of your vendors who are reporting to Dun & Bradstreet, which is the main credit reporting line for commercial businesses. So you have your DMB number, I believe is what it's called. So the problem is going to be they might not be reporting it properly to the credit reporting agencies for business credit. This is different than like Experian, TransUnion, and stuff on your personal credit side. So from a business credit standpoint, yes, it could hurt you. Now, I don't know how much you've already built over there. I wouldn't necessarily think of the value of the name, the change of the name by branding or something like this. So if this is like a operating business that the brand is important, I would make that from a business decision and deal with the credit thing down the line. If you want to try to get the best of both worlds, you're going to have to try and make sure all your vendors know this is the same company. We just changed the name to make sure that they still keep reporting that history, and that history ties over to the new name that you use. I just think practically that's going to be, there might be some hiccups, is what I'm saying. Because that business credit line of reporting is not as clear cut as you would think.
Okay, William from YouTube is asking, is it okay and not an audit risk to have an LLC or S Corp that's literally zeroed out by maxing solo 401k up to the annual contribution limit?
No, I mean, it's not an audit risk. I mean, you could be zeroing it out. I presume you're doing traditional contributions and not Roth if you're doing that and getting the tax deductions, but you will still have a W-2. So think about this. If you're an S corporation, like if you're maxing out a solo K, you should be an S corporation. Okay. But in order to max it out, you must have, you're going to have to do a W-2. So the profit on the 1120S in your K1 that shows how much profit came down to the business could be a 0 or even a loss, but you're still going to have a pretty big W-2 because you're maxing out the solo 401k contributions. Now, if you're just a sole proprietor, the amount you can contribute is your taxable net income on your Schedule C. So the IRS is going to see that you calculated your solo K contributions off the net income, and then they'll say it get reduced after the fact by the 401k contributions, which is totally fine too. So I definitely don't see that as an audit risk, but that doesn't mean you're not paying any tax, because you will have a W-2 in the S Corp route, which you'll have some self-employment tax on, and you're going to have some taxable income on it. Now, you could have a loss on the K1 of the S Corp 2 that offsets the W-2. I don't know all the intricacies of the business and your numbers. So yes, it's possible, but just think of those logistical things, the W-2 on the S Corp, and also you're going to need to have taxable net income in order to claim, in order to make a solo K contribution if you're just Schedule C. And we love S Corps, by the way. For you operating business owners, and we love the S Corp with the solo K as well. For those of you that are solopreneurs, you can put $69,000 a year in a solo K. We set up those solo Ks at Directed IRA. Our law firm works in connection with our clients on those at KKOS Lawyers. So if you're like, what was that he's talking about, a solo K? Guys, this is the #1 retirement account strategy for small business owners, the solo 401k. It's basically a 401k you can have for yourself as a business owner, where you can't just put like $7,000 a year in like you can in an IRA. You can put $69,000 a year into a solo 401k. So that's where that question was headed at, is using the solo 401k, which we love to do. So look into that if you haven't heard that. And I've got a lot of videos that go into using the solo 401k.
Awesome. Okay. I'm going to just pop this solo 401k question in here just because it just came in. Brandon wants to know, can you do a solo 401k if you have 2 businesses and one of them has employees, but the other does not?
Brandon, the general answer is no, but the long answer is it depends. I know that might sound like a broken record with that answer, but it kind of gets into the ownership. If that's just you 100% that owns one business with no employees, and you have another business with employees 100%, the answer is probably no, unless one of those businesses is very large. And I mean like very, very large. If you have partnerships where you have some partners in those, it gets into these controlled group rules. That's where you definitely need to consult with a tax lawyer to kind of look into your situation. There's brother sister control groups. There's parent subsidiary control group rules. It gets kind of complicated. So, but just know there might be some daylight if it's a partnership scenario where you have one business that has partners that let's say don't do any retirement account. And then you do have a business where you do a solo K that's just you. It could be possible you get away with that. So, but you got to get into the details on that. There's no way I could do it justice here in the last couple minutes.
Awesome. Next question is from Moy. Can you convert an S Corp to C Corp in order to have non-US resident as an owner, or does it not matter?
So if you are an S Corp and you have a non-resident or someone with non-status or not a U.S. citizen as an owner of your S Corp, you actually are automatically a C Corp by default. So, I mean, you may want to make that election clear with the IRS and just you can do a choice of entity tax election form to the IRS to say that. But that's the penalty. And I've ran into this over the years where people had an S corporation and they have a non-qualifying shareholder. Well, technically to the IRS, immediately when that shareholder came in that didn't qualify, that went from an S Corp to a C corporation. Another thing you might do is just go to LLC. You don't have to go to C corporation. You could do what are called articles of conversion and convert the corporation to an LLC sometimes and just be a partnership for tax purposes, where maybe your S Corp owns your share and then the non-US citizen just owns theirs personally. So a lot of times we'll do that. It's just, I'd rather go to an LLC probably where you still use an S Corp for you if you're a US citizen or have green card or other status in the US. And then the non-US citizen just individually owns in the partnership structure. So I was using a lot of hand gestures there. Let me show you what I mean here. So let's say you have an S Corp and you have let's see, there's two partners. One of them is a US citizen. One of them is non-US and has no status that qualifies for S Corp status. So if you are an S Corp, what I would probably do is move over, convert this over. This will take some work. This is not easy. This is not like a, easy button. It'll take some work from one of the lawyers. Do an LLC. You have your S Corp own it as a US citizen. And then the non-US citizen just owns personally. Another option would be, let's say it's just like this right now. You just own it, but you're going to bring in a non-US citizen as a partner. You keep your S Corp and you start a new LLC that your S Corp owns 100% and you drop or owns 50%, let's say, if you're 50-50, and they own over here like this, and they're, of course, the non-US. Okay. The handwriting's not improving. It's a little better, actually. But I hope that makes sense. Some options there. All right, what else we got? Anything else?
Okay, this is the last question, okay? I saved this one for you. It's a lot of information here. So Hone Zone from Instagram.
Oh, love Hone. I love Hone Zone.
Yeah. If I have an S Corp and an LLC for passive income, should I have the LLC bill the S Corp for services so I can reduce my S Corp income? Though it will increase my LLC income, I won't have to pay FICA.
Okay. Let's diagram this out. Okay. So Hone's question is, okay, you've got a S Corp, LLC, and he wants to pay for services from the S Corp to the LLC?
Yes.
Okay.
Or no, sorry. Should I have the LLC bill the S Corp for services?
Okay, so the LLC is going to bill, but the S Corp has to pay the bill.
Yep.
Okay. Okay. All right. Just making sure I got the flow of money right. Okay. No. So this is not going to work because no, this just won't work. So because what's the nature of this income going to be coming over to the LLC? Providing services. Okay. So sure, I get to expense it over here in my S Corp, but I pick it up as income over here. And what type of income is this? Ordinary. Well, Matt, I've got some rental properties over here in my LLC. Okay, that's rental income. That's capital gain income when I sell it. This ordinary income over here doesn't mix with that for loss purposes and income and loss purposes. So I don't get a net out this income against the rental property or the capital gain income I might have. So I don't see a reason to do this, because what's going to happen over here is now I've got an ordinary income in this LLC that might have some rental income and some capital gain income when I sell a property, but that ordinary income isn't mixing in with that. It's in its own little bucket. And what am I going to pay on it? Self-employment tax. And I don't have an S Corp structure where I can do the salary dividend split. So I would not do that. And the primary reason is I don't get a net my services against the LLC, the income I'm getting for providing service to the S Corp against the rental property income. So, so that's going to be a no. We do the opposite sometimes, where we have the LLC, let's say, that owns rental real estate, paying over a management fee to another LLC or to an S Corp over here. The reason we do this sometimes is for clients that have like lots of rental real estate and they want to do a solo K. And they're like, man, I want to do a solo 401k, and maybe I got some old IRA or employer 401k dollars. I want to roll to the solo K instead of a self-directed IRA. But I don't have a business. I've only got rental properties. Well, that LLC for rental properties, I can't set up a solo K in that. A solo K has to be attached to a business that provides goods or services or ordinary income. So anyways, sometimes we do the opposite solely for the purposes of setting up a solo K. But again, what did I do here? I took rental income, which I don't pay self-employment tax on. I converted it to a service fee over to another LLC that's going to go on Schedule C, or to an S Corp that's an 1120S, where I do pay self-employment tax. Now I can minimize it in the S Corp. Why would I do that? The only reason you would do that is to justify a solo K, which provides other tax benefits. But if you're not doing a solo K, never do this. Never pay a management fee over to another entity of yours from your rental properties, because you're just forcing there to be business income or ordinary income when it could have flowed through as rental income or capital gain exempt from self-employment tax. All right, we had one question that came in, though, I did want to hit, and this will be the last one. This is from SAIF. Well, your name's difficult to say. Let me just say that. The handles here are tough. But the question was from YouTube, and it says, does a Montana LLC work for an e-com business? Well, yes. I presume you're asking this because you're in Montana. So if you have an e-commerce business, the IRS doesn't really care where your LLC is set up. You could do a Wyoming LLC. You could do a Delaware LLC. You could do a Montana LLC. But where do you live? Because that's where the business is being conducted from. And from a tax standpoint, that's the taxes you're going to pay. That's going to be the nexus for sales tax as well. So generally, we're going to be setting up an LLC in the state you reside for your e-com business, because that's where the income is going to be generated. I know a lot of people in California are like, but Matt, California LLCs have to pay an $800 fee. Well, guys, if you do business in California, I don't care if this is an e-commerce business and you're actually located in California, or you have a business that provides services directly in California, you own a rental property in California, you're going to need to do a California LLC or S corporation. Now, maybe you want to move out of California, and so you're like, well, I'm gonna maybe move to Montana in the future. Cool. We could set up an LLC in Montana, and then that way you're not stuck in California with that entity, and it's e-commerce, so you're going to get out of it eventually once you physically move out of California. But while you're still there, California cares. They want to charge taxes on it. They want to charge their annual $800 fee for it. If you're still physically in there, they're still going to be able to legally collect that from you. So there's not a lot of gymnastics you can pay. I think California is probably the worst state for that. But as a rule of thumb, we're going to set up the LLC in the state where the business is being conducted. If you're selling goods or services, your LLC or S Corp is going to be in the state where you reside. If you have a rental property, your LLC is going to be in the state where you have a rental property. For example, I have a lot of entities for my businesses in Arizona. Why do I choose Arizona? Because I live here. Okay. When I lived in Utah, I had a lot of entities in Utah and still do because I do have businesses there and conducted business there. My rental real estate, I have rental properties in Indiana. Why is it in Indiana? Because the property's in Indiana. I have LLCs in a lot of other states. Why are they in those states? Because that's where the property is located. So we're generally going to look at where's the business conducted or where's the property located for choosing the state for the LLC or S corporation. And don't get stuck in Nevada or Delaware, these crazy states. Sometimes there's use cases for Wyoming. I've got some other videos on that. Make sure you click here. I'm going to throw the video in here later, or click below. I've got information about when to use the Wyoming LLC. That is sometimes an issue where we do choose Wyoming as a specific state in limited situations. So all right, well, make sure you please subscribe to the channel on YouTube. If you're following me on other social media, I provide more updates on YouTube. We post these videos later up on YouTube. And please get over to mattsorensen.com. We'll drop the link as well, mattsorensen.com. You can join my private Facebook group there for Team Wealth Building. And also you can subscribe to the newsletter to get updates on what's going on. And you can ask a question. Go to Ask Matt. Some of these questions we had come in from Ask Matt. You can actually record a question. My goal is to start playing some live recordings of people's questions and then answering them here on the show. So you can get over there and do an actual audio request of the question. Oh, okay. Do we have time for one more? Is anyone even still, are we still, let me just got, okay. Just for purposes of the recording, because Richard asked this question in the Team Wealth. He said, Richard asked, how about proper setup of a business entity within a trust and having everything owned by the trust, real estate, business, life insurance policy, assets, AKA the bulletproof trifecta? What type of bank account to use for holding over six figures and being able to transit that trust after you pass on to keep alive for future restorations? Your team helped me set up the first part. I am still early on building wealth, and at least I feel good about having a solid foundation. Okay, so let me actually go to the diagram here because that's what Richard is asking about, is the trifecta. So this is what Richard's asking about. We have the business here, the S Corp. We have it owned by your trust for estate planning, and you have an LLC. The LLC will have its own bank account. The S Corp has its own separate bank account. And if you have life insurance policies or stuff like that, that's titled into your trust for when you die. That's the beneficiary. So this is how it all comes together. Choosing the right entities plus incorporating your estate plan is the trifecta, and that's what Richard's talking about there. So if you need help with that, get over to KKOSlawyers.com, my law firm. We can help you with that. All right. Thanks, everybody. We will see you again next week. Until then, please go, like I said, to my website, subscribe. We'll see you next time.